Corporate finance ratios, what they are and how they could affect prices of stocks in your portfolio. Corporate finance ratios are quantitative measures that investors use to evaluate businesses. These ratios are part of the catalog of metrics used by financial analysts, equity research analysts, investors, and asset managers to assess the overall financial health of businesses with the end goal of making better investment decisions. These metrics are also heavily scrutinized by financial managers and C-suite officers, enabling them to get an in-depth understanding of the company's performance. Welcome back, folks, to another edition of Sweetie Q. How are you doing today? I hope you are doing fantastic. I'm doing marvelous. If you were to ask me, if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about corporate finance ratios, what they are and how they could affect prices of stocks in your portfolio. Not just the prices of stocks, but also the prices of bonds in your portfolio. Let's talk about the four types of corporate finance ratio that we currently have seen in the industry. Let me just kind of they can be broken down into four categories, those ratios, and they allow you to evaluate several aspects of a company's operational ability to move ahead, operational performance. So you have liquidity ratios, operational risk ratios, profitability ratios, and efficiency ratios. So the differences between these categories are actually explained in the graphic we're showing on the screen right now. So you have liquidity, operational risk, profitability, and efficiency. Let's start with liquidity. What is liquidity? Liquidity risk is basically the adverse possibility that a company will not have enough cash to remain liquid, so to be able to meet its short-term liabilities. Now, short-term liabilities means that debts that are due within one year. So the liquidity also measures the amount of cash cushion that a business has in each accounting period. So the accounting period can be 1 year. Some companies, so the accounting period can be 6 months, 9 months, especially if you have to do internal analysis. Liquidity is also useful for evaluating cash management strategy. And then you have operational risk. So operational risk here evaluates the amount of inherent risk that a business capital structure and operating model carry. Now, capital structure means the mix of cash, financing, so that is loans, and other equity funding that a business has. Operational risk also helps managers measure a business creditworthiness and ability to meet its periodic liabilities. Folks, liability again means debt, obligations. And you have long-term liability, those that are due after 1 year, and short-term liabilities, those that are due within 1 year. And operational risk is also useful for evaluating leverage. And then you have profitability. The profitability, that's what the average John Doe or Jane Doe knows about, because profitability evaluates a business's ability to generate profits given the investments made in assets or equity. Assets run the gamut from cash to equipment to intangible assets such as patents and copyrights. Profitability also measures how well the company's management has used funds to develop a profitable operational model. And then you have efficiency. That's the fourth. So efficiency ratios evaluate the overall level of efficiency that a business is able to achieve through its operations. So efficiency simply means that, let's say I give you $100. How efficient can you use the $100? Are you going to waste it? Are you going to use it efficiently? Are you going to use it profitably? So if you give $100 to two individuals, maybe one will use that money properly, and the other might have some kind of waste, some kind of squandering of the cash. I'm trying to simplify things here, but it kind of gives you an idea of what efficiency stands for. So efficiency measures business performance in terms of multiples of themselves, so turnover, and it's very useful for identifying areas of improvement. Right? I was speaking earlier about wasting money, wasting resources. So if you analyze efficiency ratios, you can find out whether there is room for improvement. The thing is, how do you use ratios? So if you are an investor, if you are a financial analyst, if you are an investor, a current investor, or you are looking into buying a company stock or bond, how do you use that? Now, corporate finance ratios enable analysts, management, and investors to assess the financial performance of a company by ranking them against time series data, competitor data ratio, or performance targets. So you have time series data whereby you compare historical data versus current data. So you compare the company's achievements or performance over the last 5 years. That's time series data. You can also use you can also evaluate the financial performance of the company versus the competitors if the company is overachieving or underachieving. Or you can actually compare that based on set performance targets. So if research analysts or experts in the industry have set certain performance targets, you can calculate the financial ratios of the company and compare them with those established performance targets. Ratios are not meaningful by themselves, folks. This is important. So if you want to draw better insights from them, you need to calculate the same ratios for a number of different companies that operate within the same industry. What I was just talking earlier about analyzing the ratios of rivals also. Because by doing that, you will have a better idea of what's really going on in the industry. You can't just say, oh, this company is underperforming. But if you haven't reviewed what's going on in the whole industry, how do you know if the company is underperforming? They might actually be overperforming. So by doing a competitive analysis, you are able to better understand how well a company is performing within the context of the industry. Ratios also can be computed at various periods in time in order to see how they have evolved over time. So you can do a ratio every 3 months, 6 months, 12 months, 2 years, 3 years. You can do this ratio analysis for a single company or for a number of companies operating in the same industry in order to observe how specific metrics have changed. What you're trying to do here is called trend analysis. Trend review at the industry level, but also at the company level. Remember also that ratios can be used to benchmark the performance of a company's management team against targets that were set out earlier. Sometimes some companies, especially the board of directors, they compensate their management teams when certain specific ratio targets are achieved. So, for example, a CEO of a big pharma company may receive a special bonus if under her tenure, the company is able to increase its return on equity by, say, 15% or 20%. Another thing I want you to understand here, and this is something that you really have to pay attention to, and we're showing this on the screen. We have three very important elements that I want to talk about here in terms of analyzing the corporate finance ratios. And I want to take some time to do a little bit of analysis. I talked about this a little earlier, but I want to break it down. If you want to know how the financial ratios of a company can affect the stock in your portfolio or the bond in your portfolio, you need to do those three things. So compare them against competitors' ratio. Look at the trend in terms of the ratios themselves. So from 1 year, 3 years, or 5 years, and try to use those as a benchmark to see how the current CEO and his or her team are doing. Let me give you an example. Let's say you want to buy Facebook and you are interested, or you currently have Facebook stock in your portfolio, and you want to figure out whether you should sell the stock or keep it. So you can go ahead and analyze Facebook's finance ratios. Again, the four financial ratios are liquidity ratios, operational risk ratios, profitability ratios, and efficiency ratios. I'll give you later on the some of the the formulas, so you know a lot more about those ratios. So don't worry, don't worry. I'll give you the formulas. But so Facebook, going back to what Facebook, I was our example. So you can calculate the four types of corporate finance ratios for Facebook, and you want to compare those ratios against, say, the ratios of Twitter, the ratios of Pinterest. So you want to look for other prominent social media up there and compare them. You can also compare those ratios versus the ratios of YouTube, which is a subsidiary of the Alphabet, the parent company of Google. So you're trying to compare those ratios against competitors' ratios. You can also see if Facebook, in this example, has actually grown operationally, financially, and risk-wise over time, over 1 year, over 2 years, over 5 years. And you can use the ratios that you will have, the four types of ratios, to evaluate Mark Zuckerberg's performance over time. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation today around corporate finance ratios, what they are, and how they could affect the prices of stocks and bonds in your portfolio. And if you love this kind of content so far, please consider subscribing to our channel. We're trying to grow our community, and smash that like button and turn on the notification bell so you are informed in real time whenever we release a new show. We release this kind of shows every single day, folks. Every single day, rain or shine. Like this content, share, and comment below. Let's talk about corporate finance ratios, but one type. The first type, liquidity ratios. I promised you earlier that I was going to give you a formula so we can have more. We can have an in-depth conversation here. So we are going to put on the screen each ratio that I'm talking about. So first we have capex to operating cash ratios. So what is capex? Capital expenditures. So anytime a company buys heavy equipment, buys a machine, buys a car, buys or sets up a plant, this goes into capex. This goes into capital expenditures. Capital expenditures are expenditures that are long-term. They have a useful life or of more than 1 year. Accountants call it, they call this kind of expenditures capital assets, and they are usually depreciated over time. So let's say if you build a plant, you might want to depreciate it over 10 years or 30 years or 40 years or 50 years, depending upon the depreciation method used and the trends in your industry. So capex to operating cash ratio measures how much a company's operating cash flow is funneled into capital expenditures project. So the formula is cash flow from operations divided by capex. Cash ratio. This is a liquidity ratio that measures a company's ability to pay off short-term liabilities with highly liquid assets. What are the highly liquid assets? I'm talking about cash and cash equivalents. So you have short-term bonds, you have money markets accounts, you have certificate of deposits. Those are highly liquid assets. A highly liquid asset is something that is an asset you can sell right away and get your money. You don't have to look for a buyer. No, there are always buyers available. So the formula is cash and cash equivalent over current liabilities. The current ratio measures a business's ability to meet its obligations that are due in less than 1 year. So the formula is current asset divided by current liabilities. Folks, current assets and current liabilities are assets and liabilities respectively that you can use within a year or that are due within a year. So when you hear the term current, in finance or accounting, current means short term, and short term means less than a year. Defensive interval ratio. This compares a business current asset to its daily cash expenditures. So it's current asset divided by daily expenditures. You have the operating cash flow ratio. This evaluates a business ability to pay off short-term liabilities using the cash flow from operations. So the formula here is the cash flow from operations divided by current liabilities. The quick ratio. Quick ratio is different from cash ratio. Quick ratio is also called asset ratio. So quick ratio, the question you ask yourself is, do the company's current asset easily cover its current liabilities? So you have cash and cash equivalent plus marketable securities plus accounts receivable divided by current liabilities. Marketable securities are stocks, bonds, and other securities, other financial instruments that a company buys with the intent of doing short-term trading. When talking about individuals, you call it swing trading. So they buy and sell. They buy and sell. They're just trying. This is a pure treasury strategy. They're just trying to make some extra cash on the side, by investing in the financial markets. So that's This is marketable securities times interest earned. That's the cash basis ratio. This will help you evaluate a company's ability to meet its debt obligation with cash. So the formula is adjusted operating cash flow divided by interest expense. Folks, the great thing here is that all those metrics, so cash flow from operations, current asset, the daily expenditures, adjusted operating cash flow, interest expense are visible in the financial statements of a publicly traded company. So if you have a public company, you just got to dig into the financial statement of that company, and you get all the things I'm talking about here. One thing you also want to understand is that there is something called, when it comes to analyzing liquidity ratio, you got to think about what is high liquidity versus what is low liquidity. If a company has plenty of cash or a liquid asset on hand and can easily pay any debt that may come due in the short term, in other words, within 12 months, that is an indicator of high liquidity and financial health. So if you have a company that's just sitting, a company such as Amazon or Apple or Google that has billions of dollars just sitting in the bank, they were just relaxing. That ka-ching that you have in the bank is a sign of high liquidity. Now, I'm not saying that it's always a good sign, because it could also be an indicator that a company is not investing sufficiently. To calculate liquidity, short-term liabilities are analyzed in relation to liquid assets to evaluate the coverage of short-term debts in an emergency. So the way if you want to analyze or evaluate liquidity, you use the current ratio, the quick ratio, and the operating cash flow ratio. In some scenarios, though, a high liquidity value may be key. However, it's not always important for a company to have a high liquidity ratio. The thing is that you want to make sure the company has access to cash and can actually raise funds very easily, because the basic function of the liquidity ratio is to measure a company's capability to settle all short-term debt, again, within 12 months or so, with all current available assets. The stability and financial health, or lack thereof, of a company and its efficiency in paying off debts is very important to potential investors, creditors, and market analysts. One thing I also want to say before moving on is that a high liquidity ratio is not essential. It's not always essential. The lower the liquidity ratio, the greater the chance the company is or may be soon suffering from financial difficulty. However, a high liquidity rate is not necessarily a good thing. And as I was saying earlier, it means that the company is overly focused on liquidity, which can be adverse to the effective use of capital and business expansion. Remember, if a company is not expanding, what are they doing? They're shrinking. If you live, especially in this global environment that we currently are, companies have to constantly vie for market share, not just at a local level. They have to do this at a global level. So if they're not growing and grinding locally or nationally, they are shrinking. So a company, for instance, may have an impressive high liquidity ratio, but precisely because of its high liquidity, it may present an unfavorable picture to analysts and investors, because they might want to consider other measures. The company is not using the cash it has. They might look at profitability ratio, for example. They might look at something called ROS, so return on capital employed, and ROE, return on investments. Now, ROS, return on capital employed, is a measurement of company performance with regard to how efficient a company is at making use of capital available to it to generate maximum profits. Let's talk now about operational ratios. What are those? There are several of them. So let's just quickly go through them. So you have asset coverage ratio. This measures a company's ability to cover debt obligations with assets. So the formula, again, folks, we're putting all the formulas on the screen so you can see it. So asset coverage ratio is total asset minus intangible asset minus current liabilities minus short-term debt divided by interest expense. Cash coverage ratio. This measures a company's ability to cover debt obligations with cash. So the formula here is total cash divided by interest expense. And then you have cash flow to debt ratio. So this calculates the percentage of debt that could be paid off using cash generated from operations. So the formula is pretty straightforward. So you have cash flow from operations divided by total business debt. Folks, when I say cash flow from operations, this is money that the company derives from its day-to-day business. This is different from cash flow from investments and cash flow from financing. So remember, in a typical cash flow statements, you have three categories. You have cash flow from operations, cash flow from investments, and cash flow from financing. So cash flow from operations typically come from things like accounts receivable, so it comes from sales rather. It comes from other ancillary activities the company is doing on the side. For instance, short-term marketable securities. So when the company buys and sells stocks to make some extra cash, that goes also in cash flow from operations. And then you have the debt service ratio, debt service coverage ratio. This evaluates a company's ability to use its operating income to repay its debt obligations, including interest. So the formula is operating income divided by total debt service. And then you have debts to asset ratio. This helps you envision a company's debt load in relation to its asset. And that's pretty straightforward. So total debts divided by total asset. Ideally, you want it to be as low as possible, right? You want your debt to asset ratio to be as low as possible. For example, if a company has a 20% debt to asset ratio, that means that the company, for every $100 that the company has in terms of asset, it has debts totaling $20. That's 20%. So the lower the better. When it comes to individuals, just to give you a quick metaphor, not a metaphor, to give you a quick analogy here, they call it debt utilization ratio. So if you have a credit card, for example, you want your debt utilization ratio to be as low as possible, because that means that based on the limits that you have on the card, you are tapping into as little as possible of your limit. And then you have interest coverage ratio. This measures a company's ability to cover debt obligations with operating income. So the calculation here is operating income divided by interest expense. And then the last operational risk ratio is times interest earned ratio. This computes how many times over a company could pay its interest expense with its earnings before interest and taxes. This is EBIT divided by interest expense. Now, let's kind of dig a little deeper into the whole. I gave you the ratios, so I gave you the operational risk ratios. But let's talk about what is operational risk. Operational risk summarizes the uncertainties and hazards a business faces when it attempts to do its day-to-day business activities within a field or industry. So, operational risk is part of the larger category of exposures a company has to deal with, and that's called business risk. So operational risk can result from breakdowns in internal procedures, people, and systems, as opposed to problems incurred from external forces such as political or economic events, or inherent to the entire market or market segment, known as systematic risk. So when you hear operational risk, that deals with the company itself. It comes only from the company. It is endogenous. The source is endogenous. It's not exogenous. So, but when it comes to exogenous risks, you either have systematic risk, or you have geopolitical, economic events, or foreign currency risk. Operational risk can also be classified as a variety of unsystematic risk, which is unique to a specific company or industry. Understanding operational risk is important, especially if you want to invest in a company stock or a bond, or let's say you just want to periodically assess the validity of your earlier financial choices. And it allows you to focus on a few things. It allows you to focus on how things are accomplished within the company and not necessarily what is produced or inherent within an industry. You're trying to see how well the company is run. You're trying to see how well the company is using the resources that investors have put at its disposal, because operational risk is often associated with active decisions relating to how the organization functions and what it prioritizes. Now, this kind of risk is not guaranteed. Is not guaranteed rather to result in failure, overall cost increase, or lower production. But this risk is seen as higher or lower depending on various internal management decisions. Because operational risk reflects primarily man-made procedures and thinking processes, this is something that can be summarized, if you think about it, as a human risk, right? Because at the end of the day, this is a human risk. I mean, we're not in the era where machines are running stuff yet. So humans are still running companies. So this is human risk. It is the risk of business operations failing due to human error. It also changes from industry to industry and is an important consideration to make when looking at a potential investment, or just buying the business, for instance. Not buying the shares, but buying the business itself. So industries with lower human interactions are likely to have lower operational risk. Let's now talk about profitability ratios. What are those? You have gross margin ratio. This calculates the percentage of revenue that are left over after COGS. COGS stands for cost of goods sold. Again, folks, we're putting all the formulas on the screen so you can see it. So gross margin ratio equals revenue minus cost of goods sold divided by revenue. The net profit margin is kind of similar to the gross margin ratio, but it looks at other metrics. So it calculates the percentage of revenues that are left over after all expenses and taxes. So it equals net profit divided by revenue. And then you have the operating margin, which calculates the percentage of revenues that are left over after all expenses. And the formula here is operating income divided by revenue. Then you have the pre-tax margin ratio, which basically displays earnings before taxes relative to revenue. So the formula here is EBT divided by revenue. The return on assets, one of my favorite metrics. This metric quantifies how much profit the business has generated given its available assets. And the formula for ROI is not ROI, sorry, ROA, return on assets, ROA. The formula is net income divided by average assets. Then you have the ROE, return on equity. This quantifies how much profit the business has derived given its available equity financing. So it's net income divided by shareholders' equity. And then the last one, last but not the least, you have return on investments, the ROI. This represents a general return figure that investors can utilize to quantify investment performance. So the formula for this is change in value of investment divided by investment cost. Now, a lot of folks understand ROI. So for instance, let's say you have invested $1,000 in a company. You bought shares totaling $1,000, and after 2 years, after 1 year, the value of those shares went to $1,200. So from 1,000, it went to 1,200. In this case, your ROI is 20%. And how do you calculate that? Change in value of investment divided by investment cost. So the change in value here is 1,200, the new value, minus 1,000, the original value. So that equals $200, and you divide that by the original investment cost, which is $1,000. So $200 divided by $1,000 equals 20%. Let's talk now about efficiency ratios. First, you have accounts payable turnover ratio. This expresses the credit purchases as a multiple of accounts payable. So the formula here is net credit purchases divided by average accounts payable. Accounts receivable turnover ratio. This expresses the credit sales as a multiple of accounts receivable. So the formula is net credit sales divided by average accounts receivable. You have the asset turnover ratio. This expresses net sales as a multiple of the company's total assets. So the formula here is net sales divided by average total assets. We're putting all these formulas on the screen for you folks. Then you have the contribution margin ratio, one of my favorites. This shows the percentage of earnings retained after variable cost. So the formula is total revenue minus variable cost divided by total revenue. Employee turnover ratio. This shows the percentage of employees that have left the company voluntarily or involuntarily. And a similar metric is, or a related metric is attrition rate. So when people talk about attrition rate, it's kind of close to employee turnover. So you have this employee turnover equals the number of employees separated versus the average number of employees. The fixed asset turnover. This expresses net sales as a multiple of the company's fixed asset. So this equal net sales divided by average fixed assets. And then you have inventory turnover. This expresses cost of goods sold as a multiple of the company's average inventory. So in general, I just want you to understand that efficiency ratios, when you are thinking about analyzing a stock or bond because you want to invest in the company, or you're currently an investor, you're thinking about whether you should buy more or exit the company altogether, the company's equity base altogether. What I'm trying to say here, efficiency ratios are kind of cool because they help you measure a company's ability to use its assets and manage its liabilities effectively in the current period or in the short term. Short term, again, as I said, it's within 12 months. So there are several efficiency ratios, but they are similar in that they measure the time it takes to generate cash or income from a client or by liquidating inventory. Efficiency ratios include the inventory turnover ratio, asset turnover ratio, and receivable turnover ratio. Those are the top three. The list I gave you earlier is more comprehensive, but the top three that you're going to need to make an investment decision is actually what I just told you. So you have the top three. Those top three are turnover ratio, asset turnover ratio. So first you have inventory turnover ratio, asset turnover ratio, and receivables turnover ratio. These ratios measure how efficiently a company uses its asset to generate revenue and its ability to manage those assets. So with any financial ratio, it's best to compare a company's ratio to its competitors in the same industry. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi, and we are about to wrap up today's show. And I just have a question. This is the bottom line. It's not really a question. It's just more like one last comment. So, how do you use corporate financial ratios to pick stocks? You have to remember three things. Number one, you have to know that four types of financial ratios, corporate finance ratios. So I spoke to you about liquidity, operational risk. So liquidity risk, operational risk, profitability risk, and efficiency. The thing here is that you want to apply those four elements in calculating your ratio. So you have liquidity ratio, operational ratio, profitability ratio, and efficiency. Once you do that, so that's the first step. Once you do that, you need now to compare those ratios to the ratios of the closest competitors. That will tell you whether this company is really kicking butt or trailing the rest of the class. So you can pick three close competitors who that have similar operations. Again, what I'm trying to say by similar operations is that if you are analyzing a chemical manufacturer in the States, you want to choose three other chemical manufacturers in the States not somewhere in Tonga Islands or somewhere in Thailand. You want to look at the very close competitors first, competitors who have the same cost structure. So that's number two. So number one, you calculate the corporate finance ratios for the company. Number two, you do the same thing for the three closest competitors. And the third thing you need to do is you need to analyze how the company is doing. You have to do something called trend analysis. So you do the trend analysis for the company. So you see over time, so how the company has been doing within a year, within 2 years, within 3 years, 5 years. Next, you do the trend analysis between the company and its closest competitors. And then you do the trend analysis in the industry. So if a company is doing great, is doing fantastic in the short run, but the industry overall is just in a lethargic trend, chances are sooner or later the company that's doing well right now will start having liquidity problems. Because if the industry is static, they're just probably doing well because that crisis in the industry hasn't caught up to them yet. So 3 steps: analyze the company's ratios, the competitors' ratios, and the industry. And you have to do a trend analysis. All right. Thank you so much for listening. I will see you next time. But until then, remember, stay marvelous.